The impact of social media sentiment on stock volatility. What is the impact of social media sentiment on stock volatility? The stock market is a big industry where people can buy and sell bits and pieces of their companies to make profits. When you buy stocks, they can go up and down. If you put a lot of money in a certain stock and it goes down, you will lose a lot of money, and vice versa. A social media sentiment is what people say online about a company. They can voice all of their opinions about a company and if you should invest in them. Stock volatility is how much this price changes on a certain stock. Because of social media, a lot of younger people have been able to better understand what stocks will rise and fall and make better investments. Social media can sway other people's opinions about a stock, and therefore they consistently go up and down. Twitter's Mood Predicts the Stock Market by Xiaozhen, Bolin, and Tuna. This quote perfectly explains just how easy the stock market can sway. How the impact of social media sentiment and stock volatility affects us. It can cause investors to panic or even give up because their investment went wrong. This can also cause companies to go bankrupt, and a company that you rely on can be gone and leave you confused. People can also feel proud and think that they are making all the right choices and end up spending too much money on a certain stock, and the result is not like what they had thought. Things like stock crashes, like what happened in the 1920s, are not likely to happen again because of all of the preventative measures. But many stocks coming down can affect things like your funds and jobs. Companies can also cut back on spending from immense loss and give you less money on your paycheck, reduce bonuses, or it is completely on hold. Of course, not getting your money is one of the worst things to happen to you, and it affects your whole life, such as food, bills, and your motivation. Types of volatility. One type of volatility is trading volatility, which is about how often people buy and sell a stock. When trading, volatility is high. It means a lot of people are quickly buying and selling the stock. This can happen a lot when there is big news about a company or when people talk about a stock a lot. Another type of volatility is price volatility. This looks at how much the price of a stock goes up and or down. If a stock's price changes a lot in a short time, it has high price volatility. This can happen when investors strongly react to news or posts on social media. There is also a thing called market sentiment volatility. This is based on people's words and how they feel about a certain stock. This can make the stock market react and make the prices move around a lot. What causes volatility? Volatility in the stock market is caused by different factors. A major cause is news about a company, things like new products or problems in the business. Investors' emotions can also cause volatility because they may hastily buy or sell a stock when feeling worried. Social media can also increase volatility because of posts and opinions. This can quickly spread to influence investors. Economic events, things like interest rates and inflation, can also make stock prices move up and down. Sometimes multiple of these things can happen and they can make the stock market even more crazy and unexpected. Things like natural disasters can also play a big part. During bad storms or unexpected disasters, companies can be destroyed, and this can make investors sell their stocks, afraid of losing their money. How to navigate volatility. Navigating sentiment volatility means you need to understand how changing opinions can affect the stock market. Investors should be paying attention to social media to see what opinions people have and if they should buy or sell a stock from companies based on things like trends. They can also see they are getting positive or negative feedback from people online. When sentiment changes quickly, the stock prices will change just as fast. Research shows that news and social media can influence the crazy way that the stock market becomes. One article explains that news and the social media can play a crucial role in transmitting volatility across social financial markets. This means investors should be careful to not react quickly and to every post that they see online. They should look towards the future and about what affects and what will happen, and if they do decide to go through with their choice. Why virality is important to know. Stock virality is important to know because it shows how the world can quickly change. It can show you how sometimes you will need to make quick decisions and how they might not always get you into something good. It also shows that when making a choice, you should not be hasty with it and think about it and what you might be getting into in that short period of time. Learning about virality helps people to not get scared when prices jump.